The only proof we have that America spent taxpayer money to prop up Japan's economy is a single photo of a handwritten note. It was sitting on the desk of the U.S. Treasury Secretary, and from across the room, one line was readable. Buy Japanese yen, $5 to $10 billion. A photographer with a long lens caught it at 11:33 a.m. on July 31st. That Friday, for the first time since 1998, the United States stepped into the currency markets and bought yen, and the only receipt for it was a scribble on a legal pad. Here's what makes this worth paying attention to. Around the same time, the interest rate America pays on 30-year borrowing hit its highest point since July 2007. And the country we just bailed out happens to hold more U.S. government debt than any other nation on the planet. So naturally, you have to ask, why are we doing this? What are we actually buying? Here's President Trump on Air Force One explaining it. Mr. President, why is the U.S. currently supporting the Japanese yen? To support what? To support the Japanese currency. Because we have a good relationship with Japan. We're very strong, very strong financially. And they were having a weakening yen, and they wanted a little bit of help, and we're always there for Japan. Japan's been very good to us, with the exception, of course, of Pearl Harbor. Friendship, financial muscle, and a Pearl Harbor reference, all in one answer. If that's not peak Trump, I don't know what is. When Tokyo got the same question, the response came out a lot more formal. Japan's finance minister said the move was coordinated with the U.S. Treasury and was meant to counter excessive volatility and disorderly swings in the yen. Strip away the bureaucratic language, and here's what that actually means. The yen was tanking, Japan was in pain, and America stepped in to make it stop. Which leads to the next question. Where does a government even get the cash to go buy a foreign currency on a random Friday afternoon? The answer is a stash of money inside the Treasury called the Exchange Stabilization Fund. The Treasury Secretary can tap it without going through Congress at all. All he needs is the president's signature, and the card is swiped. It was built for one purpose, and it's right there in the name, stabilizing the value of the dollar. But historically, that's rarely what it's actually been used for. Turns out the word stabilize was never pinned down as tightly as it should have been. So in practice, the fund tends to get spent on whatever the sitting secretary feels like. Take David Kennedy, the 60th Treasury Secretary. He reportedly used it to buy an $8,000 Oriental rug. Or William Simon, the 63rd Secretary, who took a 42-person trip to London, Moscow, and Mexico City that cost $131,000 and, as far as anyone can tell, had no clear purpose whatsoever. Once again, the Exchange Stabilization Fund footed the bill. Basically, it functions like a personal slush fund for the Treasury Secretary and the President. No Congress required, just a presidential signature, and that's it. The law governing it even states that the Secretary's decisions are final and, quoting directly here, may not be reviewed by another officer or employee of the government. But what really matters in this case isn't the fund's rules, it's what was actually sitting inside it. Because America didn't buy those yen with dollars. It sold euros to do it. About $13 billion of the fund sits in euro-denominated assets, and that's the pile that got tapped. America sold off Europe's currency in order to buy Japan's, and the European Central Bank didn't find out until after the trades had already gone through. Senior European officials told the Financial Times that this broke decades of unwritten protocol and had simply never happened before. When Treasury was asked about it, their answer was that they don't coordinate with anyone on how they allocate that fund, which is technically true, but is also basically the financial equivalent of pleading the fifth. And there's one more piece of the timeline worth noting. On July 23rd, the Treasury published its Foreign Exchange Monitoring List, the official watch list used to track major U.S. trading partners and flag anyone artificially manipulating their currency. Japan was on that list, alongside countries like China, Germany, and Korea. 8 days later, that same building bought Japanese currency. So to recap, America broke a 28-year streak of staying out of the currency market, funded it by dumping euros, didn't tell Europe until after the fact, and did all of it for a country it had flagged as a currency risk just a week earlier. So why help Japan at all? A while ago, I made a video about how one of the biggest threats facing the U.S. economy was Japan quietly pulling back from the American bond market. That's the real answer here. To get why Japan matters this much to us, you need to understand what Japan would have had to do if America hadn't stepped in. Japan already carries more debt relative to the size of its economy than any other major nation on Earth. This year alone, the cost of servicing that debt jumped almost 11% to 13 trillion yen out of a total budget of 122.3 trillion yen. And on top of a debt bill that's spiraling, the yen has also crashed to a 40-year low. The reason the currency is falling isn't complicated. It comes down to simple math. For decades, Japan held its interest rates pinned near zero. Whether that was smart policy or not is up for debate, but recently they've started unwinding it. Japan's benchmark rate now sits around 1%, while America's is sitting between 3.5% and 3.75%. That gap is basically the whole story, because capital doesn't have feelings. It's not some clingy ex who keeps texting back. Capital simply flows toward wherever it earns the most. So investors dump yen, chase the better return in dollars, and send the currency plunging. This is usually the point where armchair economists chime in with, "Why doesn't Japan just raise rates and close the gap? Problem solved." Except they can't. They're boxed in by a monster of their own making. To keep borrowing costs near zero for that long, the Bank of Japan had to keep buying up its own government's bonds, trillions of yen worth, year after year, until it ended up owning roughly half of the entire Japanese government bond market. It's a country that solved its debt problem by buying its own debt, and those bonds pay next to nothing because paying next to nothing was always the point. But the cash commercial banks park at the Bank of Japan earns whatever the central bank's current rate is. So the second the Bank of Japan raises rates to close the gap and rescue the yen, it starts shelling out trillions of yen in interest while still collecting almost nothing on the giant pile of bonds it's sitting on. You don't need a degree in central banking to see that's a terrible trade-off. So now Japan is stuck choosing between defending the yen or being able to afford its own debt. It can't do both, which leaves Japan with exactly one option for propping up its currency. Currencies always trade in pairs. If you want one to rise, you buy it and sell the other. And since the US dollar is involved in nearly 90% of every currency trade on the planet, buying yen almost always means selling dollars. The good news for Japan? It actually has plenty of dollars. Japan is the largest foreign holder of US government debt on Earth, more than the UK, more than China, more than any other country. The bad news is that most of those dollars aren't just sitting around in a checking account. Out of Japan's roughly $1.3 trillion in reserves, about $930 billion of that is held in securities, and most of that is American government bonds. But a bond isn't cash. You can't hand a treasury bond to a currency dealer and ask for change. So Japan really has two options with its stockpile of American bonds: sell them or pawn them. Japan chose to sell. Over the course of 1 month, it mounted the biggest currency defense in its history. 11.7 trillion yen, or almost $74 billion, spent across 4 weeks just to prop up its own money, and that cash came from unloading its American bond holdings. In May, Japan's holdings of U.S. government debt dropped by $66.7 billion, the largest single-month decline in Treasury holdings by any country ever recorded. Japan needed dollars, so it sold American paper to get them. And for about 3 weeks, it actually worked. Then reality caught up. A bond's price and its interest rate move in opposite directions. Flood the market with American bonds nobody was asking for, and the price falls, which means the government that issued them now has to pay more to borrow. So here's the loop. Japan sells American debt. American borrowing costs climb, the rate gap between the two countries widens even further, and capital keeps chasing the best return, which means it keeps flowing to America. Every dollar Tokyo raised to prop up the yen ended up making the original problem slightly worse. This is what's called the FX intervention feedback loop, or the doom loop. It's a machine that eats its own tail. Every single force that was pushing the yen down before Japan intervened was still pushing it down afterward. The rate gap was still sitting at 250 to 275 basis points. The Bank of Japan still owned half its own bond market. The yen was still hovering near 40-year lows. Japan had spent a record amount of money, sold off American debt to raise it, and made a very public statement that it was serious. And not only did none of it work, it turned into America's problem too. America's long-term borrowing costs are now at their highest level since 2007, and America's biggest foreign lender had just shown the entire world in public that when its own currency runs into trouble, it's perfectly willing to become a seller, which is not exactly what you want your biggest lender demonstrating. So somebody had to come up with a different approach, and somebody did. The Federal Reserve has a tool that lets a foreign government hand over its American bonds, receive dollars in exchange, and then buy those bonds back later at a slightly higher price. Basically, it's a pawn shop. The official name is the Foreign and International Monetary Authority's repo facility, a liquidity tool for central banks built around short-term repurchase agreements. Here's how it works. A foreign central bank, say the Bank of Japan, hands the Federal Reserve $100 worth of U.S. bonds. In exchange, the Fed hands back $100 in cash. The next day, the Bank of Japan buys those same bonds back for $101. That $1 spread between the sale and the repurchase is the interest the Fed earns. The entire point of the facility is to give foreign countries fast access to dollars without forcing them to dump American debt onto the open market. It gives Japan a way to raise cash without ever having to become a seller. It's the kind of tool you build for a creditor you simply can't afford to lose. Which brings us right back to July 31st, the day the U.S. Treasury and Japan's Ministry of Finance ran a joint operation to prop up the fast-falling yen. Because just 48 hours later, Treasury Secretary Scott Bessent posted on Twitter that the FIMA repo facility was an important backstop and that he'd like to see the Fed expanded in the months ahead. Here's what makes that request odd, though. Nobody was even using it. The facility caps out at $60 billion per country, and the balance sitting there was zero. A few days after his post, Bloomberg reported the facility had gone completely unused for 8 straight weeks. So he wasn't asking for more room because Japan had maxed it out. Nobody was anywhere close to the ceiling. He was publicly asking the central bank just 48 hours after a currency operation to expand capacity for something that hadn't even happened yet. Then he went on CNBC, where the host put it pretty bluntly, "Because one thing we definitely don't want is Japan selling treasuries to do this. So you have encouraged the Federal Reserve to upsize." Bessent's response was that the goal was to protect the U.S. economy and keep any volatility contained offshore, and that the FIMA facility was last sized back in 2020 when the bond market was much smaller. So it would be reasonable for the Fed to consider upsizing it now. Which is a perfectly good answer to a completely different question. He did exactly what every official is trained to do: dodge and redirect. He conveniently left out that the facility was sitting completely unused or that its cap is only $60 billion per country, while Japan had just spent $73 billion defending the yen in a single month. Instead, he pointed at the bond market, saying it was smaller back in 2020, so upsizing would make sense now, which is true, but it's also not what he was actually asked. You don't publicly ask the central bank to expand an empty facility unless you know something's coming. Now, maybe that's just my interpretation. Maybe I'm connecting dots that don't actually connect, except I'm not the only one drawing that line. Mark Sobel, a guy who clearly knows his way around an economics textbook and who spent roughly 4 decades inside the U.S. Treasury working on international monetary policy, wrote that beyond just helping out a friend, the Treasury may also have been worried that a weakening yen could push America's own long-term rates even higher. So you've got the president saying it's about friendship, the Treasury Secretary saying it's about stability, and a man with almost 40 years inside the Treasury saying there's clearly more going on underneath. What it looks like is this. The country holding more American debt than anyone else on earth just proved publicly that it's willing to sell that debt to defend its own currency. And that turns into a supply problem in a bond market that's already sitting at a 19-year high. Here's the funny part. None of this was ever hidden. Everything I've laid out here is public information. A data release, a tweet, a blog post, a photograph. The catch is you actually have to dig for it, because the story that gets reported and the story that's really unfolding underneath rarely match up. And that's where I come in. I started this channel because I like doing the unglamorous work, reading through the boring documents so you don't have to, then telling you what's actually buried inside them. If that's worth something to you, go ahead and hit subscribe. And out of everything in this entire story, the one piece of evidence that told you exactly what was going on, with nothing hidden beneath it, was a handwritten to-do list that nobody was ever supposed to see.